Looking at these numbers, 6.2% year on year, it seems consensus they were expecting 6%. So coming in fact, above expectations.
Slightly. It's a difficult number to gauge, a very difficult one to predict. And so, yeah, 0.2% off, I'm not going to treat as too much of a deviation from the consensus. In fact, I'd treat it as pretty close to. It hasn't troubled the markets much at all.
But a leading indicator to CPI?
Well, a little bit. I think through the years they've changed the way that they calculate the PPI, and so if one has a look at this breakdown, you'll find that probably the biggest drivers of that inflation being a little bit elevated was commodity prices. The rand didn't quite strengthen as much through the measurement period. And then you've got some agricultural pressures that are coming through. Aside from the agricultural pressures, the rest of them don't always translate into a direct mechanism through to CPI to translate into a rising CPI, for example. So we need to be cautious about drawing too much out of it, but to a degree, it's somewhat of a leading indicator to CPI.
So do you think then that CPI, we had that reading coming in yesterday, 3.6%, so above expectations. Do you think we could see that reverse in the months ahead?
Yeah, it's an interesting one. I noticed, and we've certainly been on the softer side of inflation expectations. I've noticed that increasingly analysts have been looking at their base case forecasts and in actual fact revising them slightly downward to take into account of softening inflationary pressures. Perhaps we've gone into a phase where things are a little bit more neutral for a while, at least until the rand strength starts to once again exert downward pressure on inflation. So we're not of the opinion that inflation has bottomed, like many are out there. We believe that the rand still strengthens further from here. We believe that there's still deflationary pressures emerging in the likes of the US, which could be imported. And that commodity prices, whilst they've been rising strongly, at some point in time might be kept in check by a somewhat circumspect growth environment. So all of that, you pile that all together, and what you find is an environment where, well, inflation could very well subside a little bit further. We think it still holds the potential to break below the lower limit of the 3 to 6% target band, and so obviously that changes the dynamic versus what the market's priced in.
I mean, looking at what's happening in China with the inflation rate being higher above the target at 3%.
Particularly food inflation.
Exactly, PPI in fact sitting at 6.1% as well there in China. Why do you think there's such a different scenario playing out in an emerging market where surely inflation should be a little bit higher at this point in time? Does it have to do with the local currency perhaps?
Well, I think there you go. You just touched on the point, because China, one could argue that if they let their currency fluctuate, the currency would strengthen dramatically. Now, in a case where your currency strengthens dramatically, your import parity pricing mechanism would change dramatically. Suddenly you'd find those food price pressures coming off quite sharply. Equally, in terms of anything that's imported, that'll come down as well. And so there's a big offset that takes place between commodity prices, even if those are agricultural soft commodities, and the currency. So if you allow your currency to strengthen, and that's one of the positives that comes out of a strong currency scenario, it does offset many of these inflationary pressures. So in the case of South Africa, where the currency is relatively free floating compared to perhaps a China, you get potentially more of an offset coming through as the rand strengthens. In China, it's still very much a managed float.
George, you're talking about the rand strengthening further from these levels, and we're seeing it trading in the low 680s at this point. What would the drivers be for that rand to strengthen? Would it purely be dollar weakness?
Stephen, it does relate to dollar weakness, but equally one has a look at a trade-weighted rand and you'll find that the trade-weighted rand's up over 10%. We reached a fresh record for the year just last week. And so the rand is gaining, or at least remaining strong against all the majors. And in fact, the majors that you look at that it's gaining against are the ones that are still conducting quantitative easing. You can turn it any which way you like at the end of the day, but by their very nature, quantitative easing is a currency depreciative policy, and this has more to do with those currencies weakening as opposed to the rand being this one hugely powerful currency that's just rampant against all of those.
George, US Treasury yields surging on the back of worries about what impact Bush-era tax cuts could have. But surely, when you look at the quantitative easing that they've been embarking on, that basically is the same result, because you're just increasing your debt, your long-term debt. So how is that going to play out? Because we've seen dollar strength on the back of US Treasury yields surging.
Well, I mean, that dollar strength we need to look at in context, because just over the past couple of days it hasn't been strengthening. So yes,
today
we look
it's stronger,
at
though.
Today it's a little bit stronger. But if you have a look at what's happened on those US Treasury yields, the way we interpret it is that it just further entrenches the need for more quantitative easing in the future rather than less. Ultimately, because it doesn't really resolve the US debt problem. So if you're not resolving the debt problem, and in fact the debt problem is becoming even worse, and you can't finance your government currently, how on earth are you going to do it in the future when your debt metrics are going to look even worse than they do now? It's the expectation is that this huge growth is going to come through, and that the growth is going to help tax collections revive. But if that growth doesn't come through, those tax collections don't follow through, then you're left with in a situation where you're far worse off than you were prior to the tax break. So again, if you're battling to finance yourself now, and the US obviously, and this is important, is not alone. The UK is in the same boat, many countries in the Eurozone in the same boat. So it's if it were just one country, perhaps the market would absorb all those flows, all that debt issuance. It's not. It's a number of countries that are all in the same sort of boat. And so the central banks are being forced to follow through and help these governments out. And ultimately, I think there's vested interest here. They've painted themselves into a corner. They won't necessarily want to back away from this policy now, whilst the US economy remains as fragile as it is.